Something shifted today that most people won't understand until it's too late. Silver breached $103 per ounce in a single session. Not over weeks, not in a gradual climb. A 7.3% spike that sent shockwaves through commodity markets, precious metals forums, and trading desks across the world. Headlines are calling it panic, others are calling it vindication. But what you call it matters far less than what you understand about it. If you're watching this video, you're likely in one of two camps. Either you already hold silver and you're trying to make sense of what this means for your position, or you don't hold any and you're wondering whether you've missed the opportunity entirely. The truth is more nuanced than either fear or euphoria will allow you to see. This isn't a video about getting rich quick. It's not about price targets or predictions. It's about understanding what's actually happening beneath the surface of markets that most participants don't see until the trend is irreversible. And more importantly, it's about helping you think clearly during a period when clarity will be your greatest asset. Let's walk through this together, calmly and methodically, the way serious investors approach moments of volatility. Let's start with what we know. Silver opened trading within its recent range and within hours surged past psychological and technical resistance levels that had held for months. The move wasn't gradual, it was sharp, decisive, and accompanied by volume that suggests institutional participation, not just retail enthusiasm. When an asset moves 7.3% in a single session, especially one as liquid and globally traded as silver, it tells you something about underlying conditions. It tells you that either new information entered the market or old information finally became undeniable. But here's what most people get wrong. They see a spike and immediately ask, is it going higher? That's the wrong question. The right question is, what changed in the underlying conditions that made this move possible, and are those conditions likely to persist? The move in silver didn't happen in a vacuum. It happened against a backdrop of mounting pressures that have been building for years, not days. It happened while central banks continue expanding their balance sheets, while government debt levels across developed economies remain at historically unprecedented levels, while inflation, despite official narratives, continues to erode purchasing power in ways that everyday people feel, but official statistics struggle to capture. Silver moved because the market is beginning to reprice risk, not just in silver itself, but in the monetary system that values everything else. Let's talk about what's actually driving this, and why it matters more than the headline number. First, understand that silver sits at a unique intersection. It's simultaneously an industrial metal, a monetary metal, and increasingly a strategic metal for technologies that governments have deemed essential. Solar panels, electronics, electric vehicles, defense systems all require silver in quantities that cannot easily be substituted. But the industrial story alone doesn't explain a 7.3% spike. For that, you need to look at the monetary side. For the past several years, we've watched a slow-motion unraveling of assumptions that governed markets since the 2008 financial crisis. The assumption that central banks could print unlimited currency without consequence. The assumption that government debt could expand indefinitely as long as interest rates stayed low. The assumption that inflation was transitory, then manageable, then something we'd simply learn to live with. Each of those assumptions is being tested now, and markets are starting to doubt them. When confidence in currency weakens, even subtly, assets that exist outside the traditional monetary system begin to reprice. Gold does this, silver does this. They don't move because of production shortages or demand surges alone. They move because the denominator, the currency they're priced in, is being questioned. Think of it this way. If you're measuring something with a ruler and you suddenly suspect the ruler itself is shrinking, everything you measure appears to be growing. That's what's happening now, except the ruler is the dollar and what's being measured is real value. Here's where most analysis goes wrong and why you need to think differently. The financial media will focus on the percentage move. They'll interview traders who made money on the spike. They'll bring on economists who will debate whether this is sustainable. They'll chart technical patterns and talk about overbought conditions and resistance levels. All of that is noise. What matters is the macroeconomic regime we're entering, and whether this spike represents an early signal of repricing that will accelerate or a temporary dislocation that will reverse. To understand that, you need to understand cycles. Markets don't move in straight lines. They move in waves, and those waves are driven by cycles of credit expansion and contraction, by shifts in monetary policy, by changes in how capital allocates itself when risk perception changes. We've been in an environment of artificially suppressed interest rates and abundant liquidity for well over a decade. That environment created distortions. It pushed asset prices higher, not because underlying productivity improved, but because the cost of money was kept below its natural level. It made speculation cheap and saving expensive. It rewarded leverage and punished prudence. But cycles turn. They always do. And when they turn, the assets that benefited most from loose monetary conditions tend to correct first and hardest. The assets that were ignored or dismissed during the boom tend to reprice dramatically. Silver, along with other hard assets, sat in the second category. It didn't participate in the everything rally of the past decade the way tech stocks or real estate did. It sat dormant, under-owned, under-discussed, until conditions shifted. That shift is what you're witnessing now. Let me give you a perspective that most people lack because they only look at recent price action. Silver has spiked before. In 1980, it briefly touched $50. In 2011, it approached $50 again before retreating. Each time, the move was driven by a combination of monetary instability, inflation fears, and speculative excess. And each time, the move eventually corrected because the underlying monetary regime stabilized, at least temporarily. But here's what's different now. The scale of currency creation since 2020 dwarfs anything that came before. The debt levels of developed governments are higher, not just in absolute terms, but as a percentage of GDP, than at any point in peacetime history. The tools central banks used to stabilize previous crises, lowering rates, quantitative easing, have already been deployed to their limits. When silver spiked in 1980, the Federal Reserve could raise interest rates to 20% to crush inflation and restore confidence. They can't do that now. The debt burden is too large. The economic pain would be politically unacceptable. When silver spiked in 2011, central banks still had credibility that their balance sheet expansion was temporary. They don't have that credibility anymore. This doesn't mean silver goes to $200 or $500. It means the conditions that historically ended silver rallies may not be available this time. And that changes the probability distribution of outcomes. Understanding this isn't about predicting prices. It's about understanding regimes. And the regime is changing. If you already hold physical silver or silver-related investments, you're probably experiencing a mix of emotions right now. Validation, certainly. Relief, perhaps. Maybe temptation to sell and lock in gains. Maybe fear that you didn't buy enough. Let me ground you. First, if you bought silver as a long-term hedge against monetary instability, nothing about today's move changes your thesis. In fact, it validates it. The spike isn't the goal. The spike is a symptom of the underlying conditions you were protecting against. Your position is doing exactly what it was supposed to do. Second, resist the urge to become a trader if you're an investor. The temptation after a 7.3% move is to start watching minute-by-minute price action, to set price targets, to wonder if you should sell now and buy back cheaper. That's a trap. It turns a strategic position into a speculation, and most people lose when they make that shift. Third, understand that volatility works both ways. Silver can spike 7.3% in a day. It can also drop 7.3% in a day. If you can't handle that psychologically, you're overexposed. The right position size is one that lets you sleep at night and think clearly during moves like this in either direction. Fourth, don't confuse a spike with the end game. If the underlying thesis is correct, that we're in a period of sustained monetary instability and currency debasement, then this move is early, not late. The transition from one monetary regime to another doesn't happen in a day or a week. It unfolds over quarters and years, with advances and retreats along the way. Your job as someone who already holds silver is to stay disciplined. Don't add at the top of a spike out of euphoria. Don't sell at the bottom of a correction out of fear. If your position size was correct before today, it's probably still correct now. If you need to rebalance because the position has grown too large relative to your portfolio, do it methodically, not emotionally. If you don't currently hold silver and you're watching this move with a mixture of regret and FOMO, let me offer you a different perspective. First, you haven't missed anything. Let me repeat that. You haven't missed anything. If the thesis behind silver's move is correct, if we truly are in the early stages of a repricing of hard assets relative to fiat currency, then being late by a few days or weeks or even months won't matter in the context of a multi-year trend. Second, the worst thing you can do right now is chase. Buying an asset after a 7.3% spike because you're afraid of missing out is how disciplined investment strategies get destroyed. It's how people buy tops. It's how emotions override analysis. If you believe the underlying thesis, that monetary conditions favor hard assets over the medium term, then your opportunity isn't today's price. Your opportunity is the next correction, which will come. Markets don't move in straight lines. Silver will give you better entry points if you're patient and prepared. Third, if you don't understand why you're buying silver, don't buy it. Seriously. The time to learn about an asset class is not after it's spiked 7%. The time to learn is during the quiet periods when no one's talking about it, when you can study without the pressure of a moving market forcing decisions. If you're new to this, start with education. Understand the difference between physical silver and paper silver. Understand the industrial fundamentals and the monetary fundamentals. Understand the risks, the storage considerations, the liquidity considerations. Understand how silver fits into a broader portfolio strategy. And most importantly, understand your own psychology. Can you hold through volatility? Can you resist the urge to panic sell during corrections? Can you ignore the noise and focus on your long-term thesis? If you can't answer yes to those questions, you're not ready to hold silver, regardless of what the price does, let me be very direct about behaviors that will destroy your wealth during this period. Don't buy silver on margin or with leverage. The temptation after a move like this is to think, if I just used leverage, I could have made so much more. That thinking is poison. Leverage turns volatility from uncomfortable to catastrophic. It turns a correction from a buying opportunity to a forced liquidation. It turns a long-term strategic position into a short-term speculation that can blow up your account. Don't chase every headline. The financial media needs to fill time and generate clicks. For every legitimate analyst providing thoughtful commentary, there are 10 who will tell you silver is going to $200, or silver is going to $50, or silver is a bubble, or silver is the only thing that will save you. Most of it is noise. Most of it is designed to generate engagement, not insight. Don't abandon a diversified approach. Silver spiking doesn't mean you should sell everything else and go all in. It means silver is doing what it's supposed to do in a diversified portfolio. Concentration might feel like the path to wealth when an asset is moving up, but it's also the path to ruin when conditions change. Don't ignore risk management. Every position should have a thesis, a time horizon, and a position size that makes sense in the context of your overall wealth, your risk tolerance, and your time horizon. If you can't articulate why you hold something and under what conditions you'd reconsider, you don't have a strategy, you have a gamble. Don't follow Twitter personalities or YouTube channels as if they're financial advisors. I include myself in that statement. No one knows the future. Anyone who tells you they do is either lying or delusional. The best analysts provide frameworks for thinking, not predictions. They help you understand probabilities, not certainties. And don't confuse a spike with a straight line to wealth. Markets don't work that way. If you buy expecting the price to continue rising in a straight line from here, you will panic at the first correction, you will sell at a loss, and you will miss the actual long-term move. Step back for a moment and see this spike for what it actually is. It's not just about silver. It's a signal that markets are beginning to question assumptions that have held for over a decade. Assumptions about the stability of fiat currency. Assumptions about the ability of central banks to manage inflation without destroying growth. Assumptions about the sustainability of government debt levels. Those assumptions are being tested now, and silver's move is one of many signals that the tests are becoming harder to pass. Look at what else is happening. Gold continues to hold near all-time highs. Real interest rates, the return on safe assets after accounting for inflation, remain negative or barely positive. Currency volatility is increasing. Sovereign debt spreads are widening. Central banks are maintaining loose policy despite inflation that, by historical standards, would have triggered aggressive tightening. These are not isolated events. They're symptoms of a system under stress. The question isn't whether silver will go to $120 or $150. The question is whether we're witnessing a regime change, a transition from one monetary order to another, and how investors should position for that transition. If this is a regime change, then hard assets, assets that can't be printed, that have industrial utility, that store value outside the banking system, become more important over time, not less. If this is just noise, if central banks regain credibility, if inflation moderates and growth stabilizes without crisis, then silver's spike will be temporary and the monetary system will continue as before. I can't tell you which scenario will unfold. No one can. But I can tell you that the probability distribution has shifted. The scenario that seemed unlikely a few years ago, genuine monetary instability, loss of confidence in fiat currencies, a repricing of hard assets, is now firmly within the range of plausible outcomes. That shift in probabilities is what smart investors are responding to. And let's talk about something that often gets ignored in financial analysis: your own mind. Markets are information processing machines, but they're also emotional arenas. Fear and greed drive more decisions than logic and analysis. Understanding that about yourself is more valuable than any chart or indicator. When silver spikes, your brain releases chemicals that make you feel urgent, excited, afraid of missing out. When silver drops, different chemicals make you feel fear, regret, desire to escape. These are evolutionary responses that served us well when running from predators. They serve us terribly when making investment decisions. Disciplined investors understand this. They build systems that remove emotion from the process. They make decisions about position sizing, entry points, and exit criteria when they're calm, not when markets are moving. They write down their thesis and refer back to it during volatility. They understand that their biggest enemy isn't the market. It's their own emotional reactions to the market. If you feel compelled to act right now, to buy more, to sell, to do something, stop. Breathe. Ask yourself whether this urge is coming from analysis or emotion. If you can't articulate a clear reason that you'd stand behind tomorrow, don't act on it today. The investors who build lasting wealth aren't the ones who act fastest. They're the ones who think clearest. They're the ones who can sit still when everyone else is panicking or euphoric. They're the ones who understand that doing nothing is often the right action. So where does this leave us? Silver crossed $103 with a 7.3% spike. That's a fact. The underlying conditions, monetary instability, debt expansion, inflation pressure, those are facts too. What happens next is probability, not certainty. The honest answer is that multiple outcomes remain possible. Silver could consolidate here, building a base before moving higher. It could spike further in a blow-off move before correcting sharply. It could begin a sustained uptrend that plays out over years. Or it could reverse, proving this was a false breakout in a longer-term range. All of those are possible. What matters isn't which one happens. What matters is whether you're positioned thoughtfully for the range of possibilities, not betting everything on a single outcome. If you hold silver and your thesis hasn't changed, hold your position and ignore the noise. If you don't hold silver but understand the macroeconomic backdrop, use corrections as opportunities to build positions gradually. If you don't understand the thesis, take time to learn before taking action. The investors who win over the long term aren't the ones who call every move correctly. They're the ones who manage risk intelligently, who size positions appropriately, who stay in the game long enough to benefit when their thesis plays out. Here's what discipline looks like in practice. Continue educating yourself. Understand the difference between spot price and physical premiums. Understand how silver ETFs work versus owning physical metal. Understand supply dynamics, mining economics, industrial demand trends. Knowledge reduces anxiety and improves decisions. Build positions gradually if you're accumulating. Dollar cost averaging isn't exciting, but it removes the need to time bottoms perfectly. It lets you build exposure over time without betting everything on a single entry point. Rebalance periodically if you already hold significant positions. If silver has grown to represent too large a portion of your portfolio, taking some profit isn't abandoning your thesis. It's maintaining discipline. Ignore price targets. Anyone who tells you silver is definitely going to X price by Y date is guessing, not analyzing. Focus on the underlying conditions, not arbitrary numbers. Maintain diversification. Silver can be part of a thoughtful strategy without being the entire strategy. Balance hard assets with productive assets. Balance inflation hedges with growth potential. Balance conviction with humility about what you can't know. Stay informed, but don't overtrade information. There's a difference between being educated and being consumed. Check positions monthly or quarterly, not hourly. Make decisions based on changes in thesis, not changes in mood. Let me close with something important. Today's spike matters, but not for the reason most people think. It doesn't matter because of the percentage gain or the nominal price. It matters because it's a signal that markets are beginning to reprice risk in ways that favor hard assets over financial assets, tangible value over paper promises. That repricing won't happen in a straight line. It will be messy, volatile, full of reversals and head fakes. It will test your discipline and your patience. It will make you doubt yourself during corrections and tempt you to overtrade during rallies. The investors who navigate this successfully won't be the ones who trade perfectly. They'll be the ones who understand the bigger picture, who position thoughtfully, who manage risk intelligently, and who stay rational when others lose their minds. You don't need to predict the future to benefit from this transition. You need to understand probabilities. You need to manage risk. You need to stay disciplined. You need to think in time frames of years, not days. Silver crossed $103 today. That's notable. But what happens over the next few years will be determined by factors far larger than a single day's price action. It will be determined by how central banks respond to inflation without crashing their economies, by how governments manage debt levels that are no longer sustainable, by whether currency systems maintain credibility or begin to fragment. Those are the forces that will drive silver, gold, and other hard assets over the medium term. Understanding those forces matters more than watching today's price. If you take one thing from this video, let it be this. Markets are cyclical. Monetary regimes change. Assets that were ignored for years can reprice dramatically when conditions shift. But wealth isn't built by reacting to every headline or chasing every spike. It's built through understanding, patience, discipline, and the courage to think independently when everyone else is following the crowd. Silver spiking 7.3% to cross $103 is interesting. What it signals about underlying monetary conditions is important, but how you respond, whether with thoughtfulness or emotion, with discipline or panic, that's what will determine your outcome. Stay informed. Stay humble about what you can't know. Stay disciplined in your approach. And understand that navigating financial shifts successfully isn't about being the smartest person in the room. It's about being the most rational one when rationality is hardest to maintain. The crisis isn't that silver spiked. The crisis is that the conditions which made that spike logical have been building for years while most people looked away. Now the market is forcing everyone to pay attention. What you do with that attention is up to you.